So far, we have covered a introduction part. That is, into introduction, we're supposed to consider the accounting principles, accounting standards. Then, in the second unit, that is primary books, those all journals, journalizing, how we journalize a transaction. So here we consider the rules, done personal, real, and nominal account rules, their basic details, and how we consider those journal entries. We to consider those details into module number 2. In module number 3, subsidiary books, all the books, how we prepare those books. So purchase book, sales book, purchase return, sales return. So wherever and however the transactions are happening, based on which we are going to make the entry. If it purchase of goods, we are going to make entry in the purchase book. If it is purchase on credit, then we are going to mention in the purchase book. If it's going to be purchase on cash basis, we are going to mention in the cash book. If it's going to be sales on credit, we are going to mention in the sales book. If it's going to be sales on cash basis, we are going to mention in the cash book. Then in the cash book, what all those entries would appear? Basically, apart from this cash purchase and cash sales, if we are going to spend a certain amount on maybe salaries, wages, electricity bill, then discount we provide to our customer, stationaries, printing, and repairs, maintenance, then the traveling allowance, traveling expenditures. So these all expenditures would be covered up in cash. Then the entries would appear in the cash book. But largely it would appear in the petty cash book if these amounts are small amounts. So salaries, which is going to be on a frequent basis and a huge amount, will enter in the cash book. But in between, if at all, so there are going to be some small expenditures, like maybe a petrol, we require a recharge, we require maybe we need to need to give the tea bills, the afternoon and morning tea bills in the not for the employees. Those all things will cover up into petty cash book. Then in the fourth module, we consider trial balance. Now, what is trial balance? First of all, it is made on trial basis, and another it is containing all the balances. Now, which balances it is going to cover up? So all the ledgers throughout the year, whichever ledgers we are going to prepare, all ledgers will find place in the balance, in the trial balance. And this trial balance is going to be a summarized form. That means throughout the year, we spent cash, we received cash. So at the end of the period, that is on 31st March, when the financial year ends, we would be getting certain amount, maybe cash inflow will be excess or cash outflow. Then that amount will enter in the trial balance. Throughout the year, we paid salary on monthly basis to our employees. So the accumulated salary amount would be appearing in the trial balance as salary paid. Then throughout the year, if we have received rent, so that rent amount accumulated throughout the year will be finding place in the trial balance. Assume that every month we are receiving 10,000 rupees. So 10,000 rupees multiplied by 12 months, from 1st of April to 31st of March, 12 months. So we received the amount on first of every month. So 1st April, 1st June, 1st July, likewise, we received all the amounts on 1st. So overall, we are going to receive all these amounts. So 12,000 we are going to receive, 1,20,000 we are going to receive overall in a year. In such manner, we are supposed to mention in the books that yes, 1,20,000 rent is received. So trial balance will be checking all the summarized balances throughout the year, throughout the financial year. What is the objective of trial balance? Because of the trial balance, we are able to know the accounts and how much is the balance. Advantage, disadvantage, because of trial balance, it's a trial one where we tend to make certain adjustments. Now, what are those adjustments we are going to learn in our module number 5. So let's get started with module number 5 as to how the things are doing. So totaling and balancing, I yesterday shown you how we do the totaling and balancing. If, I'm just going to repeat, if the credit side is heavier as in the amounts appearing at credit side are heavier, we are going to take the total of credit side. Whatever the total appears, we are going to put the same to the debit side. And from that amount, we are supposed to deduct all the items appearing on the debit side. So we have, from that amount, we are supposed to minus out all the figures appearing at the debit side. Whatever the amount remains, that is going to be your balance for that particular account. So it would appear at the debit side to balance carried down. Now, why carried down? Because we are going to provide this balance at the end of the month. So the closing balance of earlier month will be the opening balance of the next month. So if the balance we get on 31st of January, then that's going to be a closing balance on 31st of January. It becomes an opening balance on 1st of February. Whatever is the closing balance of 28th of February or 29th for time being. So it is going to be the opening balance of 1st of March. And when it appears March, 31st of March, we are going to consider this closing balance, and that's going to be a balance in appearing in the trial balance because the year is now ended. 31st March has arrived and we are going to end our financial year. So we will be closing financial year with that particular amount and we'll keep this amount open as an opening balance for the 1st April of the next financial year. Now remember, just now we are into 23-24 financial year. The financial year has begun on 21st of April 2023. 6 months have passed just yesterday, and now we are proceeding towards end of the not towards the next half of the financial year from today onwards. So first 6 months are over and now the further 6 months are remaining. On 31st of March, we are supposed to close the accounts. So we are going to follow the same one. Throughout the transactions of April, close on 30th of April, open on 1st of May. Close for the 31st of May, open on 1st of June. Close on 30th June, open on 1st of July. Likewise, we are going to maintain these balances throughout the year. I hope that's clear to you so far. Then, when we know all these things, let's check what is going to appear at what place. Now, the trial balance when we prepare, some of the items are appearing at the debit side, some items are appearing at the credit side. So all the debit side items of trial balance would be having other next proceeding postings at asset side or maybe at expenses side or at the drawing side. That means all the assets will be going with the debit balance. All the liabilities are going with the credit balance. Expenses will be there with the debit balance. Equities will be there with the credit balance and revenue again with the credit balance. Now we will see certain more format as to how you are going to recognize those. This is just I mentioned in a short yesterday. I will be taking this ahead in front of you. So trial balance will be having debit side and credit side. All the expenditures, then all the assets, drawing and sales return would appear at the debit side. All the incomes, liabilities, capital, and purchase return would appear at the credit side. Make these things very clear in your mind so that it will become easy for you to understand the 5th unit. Now let's get started with what would appear at the profit and loss account. And what would appear at the balance sheet. First of all, profit and loss account will also be having debit side and credit side. Then balance sheet item will also be having debit side and credit side. So better I'll do something like this. Profit and loss account, and here All those things, all items which are appearing at the debit side will be mentioned. Before, this is what I was explaining. So debtors, the debit side, particulars and amount, particulars and amount. This is going to be your P&L account format. This is going to be for the year ended 31st of March and whichever the year is. Now here you will find, in case there is a gross loss, then it's going to be on the debit side. Wherever there are items appearing at the debit side, we are going to start with the writing it as 2222, TGO 2. And when the appearing at the credit side, we are going to write it as by here, BY by. Now, all those items which are of expenditure in nature would be appearing at the profit and loss account. That means all the salaries, office rent, printing stationery, telephone expenditure, postage telegram, discount, insurance, audit fees, electricity charges, repairs, renewal, depreciation, advertisement. These are all going to be your expenditure. Over a period of time, by doing a lot much of practice, you will understand which things are considered as expenditures, which are your assets. Eventually, you will come to know. It's not just at one immediate at a glance. You won't be able to understand expenditure, income, asset, and all the liabilities, a kind of classification. But yes, eventually you'll come to know. So this is all amounts which you are going to receive. Now, there could appear just one, this gross loss, it will be there, which is we are going to get from the trading account. Now, why is the trading account we prepare? Let me just clarify this first. For every organization, we are not going to maintain and prepare the trading account. Only for the manufacturing and trading companies, we do this kind of format. Like the this is going to be your trading account. Now, what is trading account mean to you? That means wherever there is going to be any purchase and sale of goods or all such expenditures, all such incomes which are there pertaining to the factory manufacturing setup will be appearing in the trading account. So if there is any raw material, finished goods, all those things are there. And when there is a manufacturing activity, trading account will be there. Now, trading account is something where we find the opening stock. What is this opening stock? That means we will be having certain stock of raw material. We will be having certain stock of finished goods. So those raw material which are yet in the process of production and such stock of finished goods which is not yet sold, those all things will find place in the stock. Now this stock is going to be opening. That means it is going to open on 1st of April 2000, whatever the year is. So we are supposed to mention this amount opening stock on whichever is there on 31st of April. So the last year's closing stock would become the opening stock for this financial year. Let's take example that the opening stock on 1st of April 2023 is nothing but the closing stock on 31st March 2023. So the last financial year, whatever is the stock there, that would reflect as the opening stock for the next year. Purchases, and whatever the purchase is, from that we are supposed to minus return outward. We call it as return outward or we call it as purchase return. We are going to cancel out the purchases. So we are going to return certain items, certain goods to the supplier. By whatever reason, maybe there is finding a damage, or there are certain, there are not as per specifications and samples. We don't require those goods, and that's why we return those goods to the supplier. So those all items would be at the minus. Wages, that means those remuneration which we pay to the factory workers is called as wages. So the monthly wages could be on a daily basis, on a weekly basis, or on monthly basis. So wages are paid to the workers working in the factory. So these are the labor which are working with us for the manufacturing process. Carriage inward. What is carriage inward? Is when we are going to receive certain goods by the courier, by the carrier, maybe from the ship, we are going to get those goods. So for that purpose, we are supposed to pay certain charges for carrying those transported materials. So from the place where it arrived till the factory premise, when it is going to give certain no carriage which we need to pay, that amount will be considered as carriage inward. Inward. Why is inward? Because we are going to unload these goods to our factory. So from that carriage, from the carrier, we are going to unload these goods to our manufacturing unit. And that's why it's going to be carriage inward. The goods are being inwarded in our business. When the finished goods are over and we are going to load those into carrier, we are going to pay the carriage outward charges. That means at the time of inward, we unload all the raw material. For carriage outward, we are going to load all the finished products for selling. Freight is again the same type of thing where we are going to inward this all raw material maybe through these cargoes and vessels. Then it's going to be freight. Now sales, when we do sales, it would appear as an income and the credit side. This is the format in which we are going to supposed to prepare. Minus sales, return sales inward, in which we are supposed to do like this. Amount will be credited. Next, buy closing stock. Here this is going to be there. Buy gross loss. Now, when is gross loss appearing? Then, in case there is excessive purchase and less sale, that means our expenditures are heavy and income is less. Then in that case, we are going to get loss. So that loss will be considered as gross loss. So gross loss would appear at the credit side eventually. Reason being, purchases, this debit side is heavier. This amount will be heavier than the credit amount. So what we do is, in case of gross loss, we are going to take the debit side total. This total we are going to write at the credit side. And from this amount, we are going to minus out sales and closing stock. Okay, closing stock is whatever the stock which is there on 31st of March at the year end. Then these all things we are supposed to consider with the gross loss. Now this gross loss from the credit side, we are going to open by gross loss on the credit side. We are going to open at the P&L debit side as to gross loss brought down. So whatever the gross loss carried down over here is going to be the brought down over at the debit side. So from the credit side to the debit side, we are going to carry it down. Now, in case there is going to be 95% there is going to be sales amount on additional and the expenditures less. 90% of this is going to happen because every business is running for earning profits. We do not make business for incurring losses logically. We want to get the profits, and that's why we are going to we are going to earn profits. So sales amount should always be higher than the purchases. Income should always be higher than the expenditure. So the gap between the same is going to be gross profit. Now how we achieve a gross profit, let's check that. In this case, our income side is heavier. That means our credit amount will be heavier. We won't be having gross loss in that case, okay? Gross loss or gross profit. Either of the two will be there. It's not going to be we have gross loss as well and we have gross profit. Now we will get either gross profit or gross loss. Now at the credit side, we need to take the total. Take this total to the debit side, and from this amount, you are supposed to minus out, deduct all the above items. So whatever you receive the balance, you will be getting gross profit carried down. So this is gross profit. When we carried down here gross profit, then on the debits, from the debit side of gross profit carried down, we put it to the credit side by gross profit brought down. So all the incomes would always appear at the credit side. So profit is our income. That means we are going to receive that. Loss is our expenditure loss. So it will be appearing at the debit side. Now, whatever the items we are going to receive, say for example, we received discount, we received commission, we received bank interest, we pay interest also on loan, we get interest on deposits. So bank interest, rent received, dividend on shares, then interest earned on debentures, profit on sale of asset, all those items would appear at the credit side. All the expenditures would be there at the debit side. Now, in case there is credit side heavier, we are supposed to take the total at the credit side, put it to the debit side, and from this amount, minus out all the above figures. When we deduct all the amount figures, we'll arrive at certain amount that will be called as net profit. This is going to be net profit. However, if it's not like this, if the debit side amounts are excessive and that is bigger amounts, then heavier, then we are supposed to take the total of debit side, put it over here, take the same to the credit side like this here, and from this amount credit side, you are supposed to minus out all the above figures. You will arrive at net loss. So this is going to be net loss. Profit or net loss, wherever we are going to receive, we are going to transfer this to balance sheet. Now let's check the format of balance sheet as well. So this is the format of balance sheet. So trading account first we prepare, we get either gross profit or gross loss. Then we transfer this to P&L account. P&L, that means profit and loss account. So we transfer this to P&L gross loss in case is there, or the gross profit if it is there. By end of this period, we get the net profit or net loss. Whatever the scenario is, we are going to transfer this net profit and net loss to the balance sheet. Now, in case there is going to be net profit, we are going to add this to capital. What appears at the liability? This is going to be liability side. This is going to be asset side, rupees over here. Now, capital will be having certain amount which is mentioned, that is equity or capital. Then we are going to add net profit there. Interest on capital would be there. Then we are going to minus out drawings. That means whatever we have withdrawn from the business, we are going to remove it from the business. So if we get profit, we are going to add profit. If we get interest, we are going to add interest. If we are going to get minus drawings, so we are going to minus it. Income tax, we are going to minus it. Interest on drawings, we are going to minus it. Net loss, in case there is net loss, we are going to mention this as again the minus amount. So net profit gets added, drawings are getting minus, and then drawings are getting minus, and even net loss is getting deducted. So all these amounts would appear at the outer column here, amount. If we have got certain reserves and surplus, mortgage, any loan would be there. So these all, whichever are payouts, we are supposed to consider at the liability side. Say we have got certain creditors to whom we are supposed to pay. Those all items would appear at the liability side. So if we have loan, if we have bank overdraft, if we have the provident fund, this will appear at the liability side. And all the assets, that is the one which we own, will appear at the asset side, like the goodwill, intangible asset, patents, trademark, the intangible asset. So these all appear at the debit side. So goodwill, patents, trademark will appear at the debit side. Business premise. So maybe building or any campus or any whatever the premises is, we are going to mention it at the asset side. Leasehold or freehold land. If we have got land and building, then our plant and machinery, furniture, fixtures. Then we have got investment, loose tools. Loose tools means all the equipment, small equipments like nut, bolts, screws, and other certain items which we require for the manufacturing purposes. Those are small parts will be considered as the loose tools. Then for certain business like the poultry business, dairy business, or woolen business, we would require certain animals. So those for the dairy purposes, the buffaloes and cows, these all become the livestock, and this livestock is also our asset. Because of these buffaloes and cows, we are able to get milk, and that's why from milk we are going to get lot many of the other dairy products. So we consider these livestock, buffaloes and cows, as a very precious asset of the business. So we mention livestock also in the assets. Then sundry debtors are also going to be there. Bills receivable, cash at bank, cash in hand. Those all going to be there. Now, if we have taken loan, please now note, if we have obtained loan from bank, that's it going to be our liability. But if we have lent to someone, that is, if we have provided loan to someone, it's going to be asset for us. So loan will appear at the debit balance. That means we are going to get this amount. Loan appearing on the credit balance, that means we are supposed to pay certain liabilities. Now, which one appear at which side and how? Let me just clarify. Okay. So personal account, and here comes the balance sheet. So nominal account, debit balance would be considered at the debit side of P&L account. Then nominal account, credit balance would be reflected at the credit side of P&L account. For the sake of balance sheet, oh, sorry, not personal account, it's going to be profit and loss account. Sorry. For balance sheet, real account and personal account, debit balance would be finding place to the asset side of balance sheet, and real account and personal account, which is having credit balance, will finding place at the liabilities side of balance sheet. This one you are supposed to remember very well. So this is how we are supposed to consider profit and loss account. Again, once again, we'll check that. Nominal account, all the nominal accounts, that means nominal account are considering all the expenditures and incomes, because the rule is debit all expenditures and losses. So debit side will have all the expenditures and losses will appearing at the debit side of P&L account. Nominal account, credit rule is credit all income and gains. So all the incomes whichever are there going to find place at the credit side of P&L account. Balance sheet will be having similar kind of thing. Real account, in which we find all the assets like machineries, plant and machinery, building, furniture, car, vehicle, any vehicle, computer, then land. These are all going to be real account. Cash is going to be real account. In personal account, we would find personal account like the debtors, like bank. These are all going to be personal accounts which are going to appear if debit balance is there. We will find place in the asset side, and if it's going to be real and personal account credit balance, like the personal capital or the bank loan is going to be again personal. Real account example there I don't have any such example there for real account. So real account, personal account, in which capital will be there, drawing will be there, bank loan is going to be there, creditors are going to be there. So these are all the personal accounts which are finding place at the credit balance, will be having place at the liability side of balance sheet. I hope this is getting clear to you. Now the next we are going to find is all the basic adjustment entries. But what you will wonder why these adjustments and what all those things are there. So trial balance we prepare for the entire year, but at the end of the period on 31st of March, there are going to be certain things which are not mentioned in the trial balance, but which are very relevant for the financial year. Like on 31st of March, we are going to receive the closing stock. Throughout the year, we won't be getting any stock, which we call as closing stock. So we are going to mention closing stock, which will be having two effects. All those items which are appearing in the trial balance will be having a single effect. At least one time posting will be there either at P&L account or at balance sheet. But those entries which are there as an adjustment, which is given as the additional information, will be having effect at two sides. Usually at one of at the trading or P&L account, and another is going to be at the balance sheet. So two effects will be going to be there for all the adjustment entries, like closing stock, stock in trade. So whatever the stock in trade to trading account. So whatever the stock was there completely, we are going to shown on the credit side of trading account. Because stock we utilize the opening stock we saw here. No, opening stock is going to be there at the trading account debit side. So closing stock is going to be there at the end of the period. Closing stock would appear at the trading account credit side. The second effect will be given at the balance sheet. So balance sheet, here you will find closing stock. I hope it's visible. Stock we will find here the second effect in the balance sheet. Next onwards, outstanding expenses. Outstanding, that means something which we have not paid. Maybe the salary which we have not paid for certain period, wages we have not paid, rent we have not paid. That means whatever is outstanding as an arrear, as a liability, which we have not yet paid, will find place in the liability side. That means we are liable to pay that. So salaries, if certain things are outstanding, that means we are supposed to add to that expenditure. That means if salary is outstanding, we will find place here that in the salary, two salaries, we are going to add that amount, that this amount we have not paid, but that becomes our liability to pay. That's why salary, in which we are going to add outstanding, and then we are going to write it at the outer column. Second entry will appear at the liability side, outstanding expenditure. This is what is going to be there. Next, prepaid. Prepaid, that means whatever we have already been paid in the year, which we're not supposed to pay. So let's take an example. We were supposed to pay the insurance premium. The insurance premium is due in the month of June every year. So we are going to pay for 2024 June, that insurance premium we are going to pay, suppose, before 31st of March. That means the amount which we were supposed to pay in the next financial year, we have paid earlier. That means we have prepaid. Prior, we have paid that particular amount. So from that year, we are going to minus out these all amounts. So usually from the insurance, if there is insurance, yes, to insurance, from insurance, we are going to minus this prepaid amount, because that amount we were supposed to pay in the next financial year, which we paid in this financial year, which shouldn't be there actually. So we are going to minus out this from the insurance, and we are going to add the next effect to the asset side as prepaid insurance. So all the prepaid items will appear at the asset side, and all the outstanding would appear at the liability side. By practice, by not reading it properly, you would come to know immediately it is going to go above your head, and you need to read these things very we can say very well.